The Southwest Florida housing market may be approaching one of its biggest turning points in years. Home prices are starting to fall, but according to the numbers, they may still have a long way to go before homes truly become affordable again. Buyer demand remains near record lows. Mortgage payments are now consuming about 38% of the average household income compared to the historic norms, which is 30%, and some builders are quietly spending $60,000 to $80,000 or more in incentives just to sell a home without drastically lowering their advertised price. But here's what I really want to show you this month. I have calculated affordability in 4 different completely ways, and every one of those methods is starting to point towards a very similar answer. And later on, I'm going to show you one Southwest Florida community where we can literally watch COVID-era equity disappearing sale by sale and explain what that means for buyers, sellers, and investors heading into the rest of 2026. Welcome to the end of July Southwest Florida Housing Intelligence Report. I'm Ed Zoller with Villa Realty Group. I have over 25 years experience full-time as an agent here in Southwest Florida, and every month I bring you the graphs, the data, and do the math so you don't have to, helping you make a confident real estate decision based on facts, not headlines. Let's dive right in. We start with supply, and as you can tell here with these graphs, when you look at graphs, you look at trends. And what trend do we see here? Well, inventory hits its highest peak in March and plummets down to September, and then hits a low, and then it goes up and it goes down, it goes up, it goes down, and every single year except for the COVID years where we just lost inventory due to people taking themselves off the market because they didn't want people in their home, we started getting back on track in 2024, and you can see the huge increase of inventory we had in 2025, and then the bottom in September, the peak in March and April. Fill in the blank. What do you think we're going to be doing? Well, supply is going to continue going down until, big shocker, September. And then it's going to start prepping for season, and we're going to start building our inventory again. I look at what I do as a local agent, and I am going on quite a few listing appointments right now, which means these listings are probably going to be popping in September or October, because I'm starting to just now get my phones ringing off the hook for people saying, I think I want to sell my home. So this is something just to look at to understand what we can kind of predict the future in this. Of this inventory of 9,211 things for sale, 866 of them are new construction. Now, last month when we found that new construction dropped like 280 homes, well, we found them. They were in expireds and terminateds. Builders just took them off their inventory sheets to make their inventory sheets not as long, but now they're putting them back on again. So they didn't go anywhere. They didn't sell. They just kind of went back on. So we expect inventory to keep going down until we bottom out in September, and then we're going to start growing our inventory again. And with more competition, with more inventory makes more competition and better choices for buyers. Let's start with demand. Now, sales are down 4%. We expected this. Why? Because again, when you look at graphs, you look at trends. Our demand, the biggest demand we have, February, March, April, May. And then what happens? That demand kind of really just falls off a cliff. Very steep angles going all the way down to hitting lows in January. Ever since 2020, we got a lower low, a lower low, a lower low. And then in January of 2025, we hit a 40-year low. We never sold as little homes in Southwest Florida than we did in 2025. So the next low was maybe 20 or 30 homes more. Still significant. Would have been a 40-year low if we didn't break that the year before. But it was a little higher. And you can see we even peaked out in sales a little higher, but every one of these peaks and valleys is still well below our long-term average. So compared to last year, July, we are still up 25%. Now, when I wrote this, interest rates took a tick up from the previous month, 6.81% as of that day. It was 6.4%, so an increase of 4.6% of the interest rate is going to affect the affordability. Of the 1,250 sales for July, 409 of them were new construction. That is a drop from last month of 3.5%, but it's still almost a third of our sales, even though they only have 20% of our inventory. So builders are still running the show, and they are kind of making this their game right now. But 1,250 sales, I mean, decent compared to 700 or 800, but it's nowhere near the 1,700 to say that we're back on track. And let's look at where the demand is going. This is a graph. The U.S. Housing Demand Indicator is a forward-looking indicator that rates multiple different graphs. The Mortgage Brokers Association mortgage applications, the National Association of Realtors pending home sales, Google searches, and the Michigan Buyer Home Sentiment. And this score is taking all of that into effect. We are ranking right now at 10 out of 100. All data points all moved in the wrong direction in July. Demand is better than the 2024 bottom, but buyers still aren't coming back. So bottom line, as long as home prices stay this high, don't expect demand to suddenly take off. Sales will likely remain flat and continue to fall further until this graph gets back to that normal demand, which is right there between 0 to 100 of 50. The median home price. Compared to last month, median home price is down. Great, because we need it to go down faster. But everyone's been asking, hey, in 2026, look how much of a bubble that looks like. Look at that circle I just did, on the graph. How nice, slow, and steady. It hit a peak and then it kind of fell off a cliff, very steep, overcorrected, got back on track. And that orange line is really where home prices should be if you graph out all the way back to the early 1970s and said houses appreciate 3% on the average over the course of 120 years, and that's what that line should look like. But every now and then, you will have these big blips in the market where it takes off too fast, goes up way too much, and it overcorrects and comes back down. But this time around, we have this really stubborn graph. And the main reason prices are so inflated is that it doesn't take into consideration about the concessions and incentives that builders and sellers are offering buyers to buy their homes. You see a neighbor sell for $368,000 and say, I'm worth that. My house is even better. I'm worth $368,000. But what did that seller have to bribe that buyer to do? How much concessions did they give? 6%, 9%. Builders can offer up 17, 20% incentives to get them to buy that home. So, another thing we looked at last month was the $1 million home sales, the high-end market. And that was really taking off this entire year, except for last month. Had a huge drop of 32% of sales, and we dropped again, 19% less sales, only 70 homes sold over $1 million. Most expensive one being $5.9 million on Fort Myers Beach. That's 4,000 square foot right there at the Gulf of Mexico. So the more $1 million homes that sell, the higher this median home price is going to be overinflated. When you only have 1,200 sales, do I really think the true median asking price of homes, or the selling price of homes, is $368,000? No. Two reasons. Why? Too many, very few sales and have $1 million homes. That does inflate that number. But second is the concessions that sellers and builders are offering. Make it that, so that tells me this price needs to be lower. And in reality, it probably already is. Later on, I'm going to show you one Southwest Florida community where we can literally watch that COVID price surge disappear sale by sale coming up. Let's talk about the builders and what they're giving. Pulte just came out with their Q2 data, and they show that other than the finance, which is a separate thing that builders do, that Pulte is now offering up 10.9% incentives, either off of price or closing costs or something other than, and this does not include the interest rates that they've pre-bought, which can cost anywhere from 9 to 11% of the loan. We're talking $30,000 to $40,000, just 10% just in closing costs and incentives. And normally they get between 3 and 6. And what I was seeing is the different quarters from 2024, 2025, they went up from 3 to 6 to 8 to now 10. So obviously they're struggling to sell their homes as well. D.R. Horton has a July Red Tag event, and they are offering, and I added this up, if you combine all the incentives, the 2-1 buy down, the extra bonus to the agent, the other realtor bonus on top of that, the 4.99 that costs 9 points to anyone else trying to do that, which is $31,000, and their flex cash of $15,000, they are giving anywhere from $60,000 to $80,000 or 17 to 24%. So they sell that home for $360,000, but they're giving you $60,000 to $80,000 off of that. What's the true price of that home? So just something, this is why everything looks overinflated and why you see these numbers. The price may say $380,000, but the builder might be spending $70,000 to $100,000 to make that sale happen. And that is not a true number. We go to the affordability graph, and something to note of this, and I've color-coded this. This takes the average household income, takes the average home, which is 1,690 square foot, 3-bedroom, 2-bath, 2-car garage, in an average location, and it takes that price, and it does a calculation based on household income. How much percent of gross income goes towards a mortgage? And as you can tell, we have normally always been in the green box. But in 2005, it headed into the not affordable range, peaked into the crash incoming up to 60% of someone's gross income going to a mortgage. That's not sustainable or affordable. What it do? It quickly dropped into that green box, and we lived in that green box pretty much from 2008 all the way to 2022. Now, a little blip. Anytime this graph has ever gone into the orange, it has either skyrocketed into a crash, but you have to ask why. Well, in 2018, Feds tried raising interest rates from 3 to 4.5. It crashed the market immediately. They said, never mind. And we went down into the 2 and 3% range, dropping us right into this affordable graph again. But now look, we got jumped into that orange, hit into the red, hit almost as high as we did in 05, 06, but we did it for much longer. And now it's hovering right smack in the middle. To get this graph down to the target zone, assuming that interest rates, taxes, and insurance stay the same, we need another 30% price drop just to get back into that zone. We need to be around $1,750 a month, and that would be affordable. So that's something to consider. And if we look at the country, this is Southwest Florida I showed you. This is the United States, and this dates all the way back to 1984. Housing is still too expensive in the country. The mortgage payment eats up 38% of household income, and historically, throughout every state, the average is 30%. Bottom line, until that 38% gets closer to 30, buying a home will continue to feel unaffordable for many Americans out there until we get back to normalcy. And you can see here, we go back to the 80s where we had interest rates in 81 and 82. I think they were 18, 19%, but the prices of the homes, even though they may have only been $50,000 to $90,000, are still a very inflated price for people of what the average household income made. Obviously, we had our 2006 bubble, but look at how much higher this post-pandemic bubble is. And this is why a lot of people out there are saying this needs to correct now. We need to not overinflate these prices and pad in things. Just let it happen and let the market correct itself. That's what my opinion is. So my little crystal ball I talked about, and I did a little short video about this last month, but I wanted to just kind of highlight because we just looked at a couple things that say we need to crash about 30% to get down to that normal. And then this graph says we need to go down about 30%. Well, what if we looked at the rent, the current rent of a 3-bedroom, 2-bath, 1,600 square foot home in the average location at $1,750? And we kind of calculated to say, are renters going to become buyers? Well, if renters can pay $1,750, why would they go through the effort of putting 3.5%, 5%, or 10% down out of pocket to have a mortgage that's significantly higher? To calculate what it would be to get a $1,750 mortgage, the average home price right now being in that $370 range, we need to come down about 30% to get that to where renters, it would make sense for them to not rent. And there's even a calculator I use that says, hey, right now, renting wins by the tune of, if you rent right now, you win by $68,000 over the next 5 years, because that's the savings you get, not having to pay for the taxes and the insurance and the mortgage on a house. And you can just rent and have $68,000 more money, more wealth than you had if you did not rent. So are renters going to become buyers in the near future? No. Another way to look at it is no different than I did before. We need to get back into that range. We're at 31 or something percent currently in Southwest Florida. To get down to that 2025, which historically we've always been in that green box, our home prices need to come down around, big shocker, about 30%. Two other ways to figure it out, just like I showed that graph. You have that 05 bubble, you have the 06, and let's just take from 2000 and say that houses go up 3%. Don't look at anything else, interest rates, insurance, anything else. What should the home price be? $262. We need to come down 31%. And the last way, and you can be in any state right now, take the average household income for Lee County's $86,384. Times it by 3, that's a rule of thumb to say that's what your home price should be. So 4 different methods, one similar answer. $247, $117 is the average of the 3, which means that our prices need to come down 30 to 33% just to become affordable. And that's where I think we're going to see any kind of demand change out there. When do I think that's going to happen? Well, if we just take graphs and we look at this home value growth, the Zoller home value index that says how much your home went up month by month. And you can see here, we are going on 35 consecutive months that we have been below zero, which means houses have lost value 35 consecutive months. The last time we crashed, it took 59 months. So let's just say a hypothetical. What if it takes 59 consecutive months? Well, if you go from peak to stable, and that would be in 2029. So there's a little prediction based on graphs and math, and that's really all graphs are, is kind of like coming up with educating yourself on the data and then coming up with a plan. So let's compare month to month. Obviously, from July to August, we lost 6% of our inventory. That's positive. Less inventory, less competition. But our sales went down 4%. Our pending sales, that's the future sales of next month, they're down 2.5%, which means we can't sell more than 1,197 homes because that's all the homes that went pending. We can't have more closings than we have pendings. It doesn't work that way. New constructions, hey, they found an extra 80, 90 homes that they disappeared. 200 of them disappeared the month before. Our average time on market, anytime it's up to 3 months, guys, that is not good for sellers. That's how long it takes you to be on the market. And that is not total time on market. That is from going to contract. Median asking price went down 1%. Median selling price went down 2%. Got a lot more to go for that. And then the asking price of sold stayed very relatively simple. So, but the big news I saw was builders found another bunch of homes, and although it looked really good last month, where we went from 2,000 new constructions down to 1,700, well, they found some and put them back on the market. The future home sales. This is the warning signs I'm looking at, because this is the graph I look at. This is for the country. This is the pending home sales that comes out from National Association of Realtors, and it goes back all the way to 2001. This is when people tell me the housing market is about to have a turnaround. Pending sales are future closings, and we're sitting around 72.5 on this graph compared to the long-term average of around 103. And we're still near the bottom of a more than 2 decades of data worth of bottoming. We didn't even go this low back in the last crash of 2006. But where's this demand? Where's this going to be driving up prices? You think you're too late. I think patience for buyers, I've been saying it time and time again, until this line starts moving up, I don't see any evidence of any kind of real housing recovery, at least for the rest of this year. My advice for sellers, your fake COVID equity is disappearing. I talked about the community. I picked Portico, a nice little Fort Myers, Florida community built by Lennar, and they have a model called the Trevi. It's one of their more popular models out there. 2,032 square foot, a 4-bedroom, 3-bath, single-story house, brand new in this development called Portico that's got great HOAs, and it's got great amenity centers and pools and all that good stuff. And I just wanted you to see this. I went back to 2019, just looking at Trevis, and I saw quite a few sales, but I just highlighted a few for the year. 2019, the whole year 2019, they were selling between 243 and 247. That's not that big of an increase. In 2020, they were selling for 248, which means that the Trevi was not even moving that much. It was just pretty much sitting there at that 240 mark. And then 2021, we had kind of this no inventory craze. So they didn't have a lot of Trevis to sell. And it took longer to construct things during COVID too. So literally not a single Trevi had sold in Portico for the entire year of 2021. But look what happened in 2022. It shot up to 354,000 in 2 years. A 42% increase. 2023, up another 9% to 388. 2024, that's where it turned. We went down 8%. And then in 2025, plummeted down 20% in just 1 year. So imagine being that person. In 2019, you paid about $250,000 and you're sitting on 34 grand of equity. It costs money to sell a home, of course. You've had it for 6 years. Did you make anything? No. Now, if you sold it in 2022 or 2023, heck yeah, you made $150,000 profit because you sold at the perfect time. I'll tell you something though. When these houses were selling for $247, interest rates were 3.5%. They're almost 7% right now. So my advice for sellers are, don't let all the COVID equity completely disappear, which is looking like what that trend is. Price yourself according to the market. You don't have to give your house away. If the last sale of a Trevi was $284, you can go on for $284, $290. But just don't think you're going to get $305, $315, $320, or say, hey, a couple years ago my neighbor sold for $350 and I want that. that. It's not going to happen when the only sales are 280. And then you got to market your home differently. And I've showed you in previous monthly housing intelligence reports how I do market homes differently, how I do get activity, how I can sell all my listings in a depleting market. And that is just with the marketing and keeping people educated. My advice for buyers is, after looking at all this, it is a market of falling daggers. Let them become feathers and fall gracefully in your hand, and do not catch blades. Wait for your price. Wait for that monthly payment you want. Pick your payment and let them come to you. And if you really want to play hardball like I do with these builders, is you can come up with something that you think sounds ridiculous. But if you're a buyer and you're interested and you found a house you want, and say, I am not buying this house until you do this, you'd be surprised how fast they do that. We still have a ton of homes for sale, over 9,000, still a huge inventory. We're probably going to bottom out around 8 is what my opinion in September, and then it's going to go right back up about 3,000 to 4,000 homes again. We'll be right back in that 12,000. The data that I use, I did pull in some information from the Resi Club, obviously National Association of Realtors. The eVenture app has great graphs, Bureau of Labor Statistics. I can do this in any city and state, so I can pull up these updates. All my data is national. Obviously, I use my local MLS for more local data that way. But if you guys need anything, you know where to find me. This is my number. The website, all my updates month by month are on LeeCountyMarketUpdate.com. For buyers out there that think, hey, I'm thinking of maybe coming up with a plan, that's what I want you to do. We come up with a plan. We talk through it first. We don't just jump. We don't try to look for homes first. There's a very specific method I've used for 27 years to perfect the buying game. And as far as listings out there, same thing goes. I have a different way of doing things, and that's how I've stayed in business for 25 years. Guys, I hope to hear from you. Please comment below, and you want to like, subscribe to this channel. I appreciate all of you. Thank you. Bye-bye.